Have you ever sat in front of the screen, looking at a trade that is losing money and telling yourself, if it just comes back to my entry, if it just returns to break even, I will exit immediately. But then, price does not come back. It moves sideways. It struggles. It goes a little deeper into loss. Then it pulls back a little. And you begin to enter a psychological journey that almost every trader has experienced, a journey from hope to despair. The scariest thing is not the loss itself. The scariest thing is what happens inside your head while you are holding a losing trade. Many people talk about strategy. Many people talk about win rate. Many people talk about risk reward. But very few people talk deeply about the psychological process when a trade moves against you. Because that is where the true nature of a trader is revealed. The psychological evolution inside each investor is something that most people rarely pay attention to. We analyze charts, we measure Fibonacci, we draw trend lines, we calculate position size, but when the account starts turning red, the only thing operating is no longer the system. It is emotion. Holding a losing trade is always justified with many reasons that sound logical. This level is strong support. Price is just sweeping liquidity. The market maker is trapping traders. News coming soon will reverse the market. The higher time frame is still correct. It sounds very professional. It sounds very analytical. But if you are honest with yourself, the deepest truth is simply this. Hope. Hope that price will return to entry. Hope that the market is wrong and you are right. Hope that you do not need to cut the loss. Hope that you do not have to admit you were wrong. Hope during a losing trade is the most authentic psychology of an immature trader. Imagine a very simple example. You have an account of $1,000. You enter a trade with a risk of 5%. That means if stop loss is hit, you lose $50. The original plan is very clear. Stop loss below the structure. Risk-reward ratio of 1 to 2. Very clean. But when price moves down near the stop loss, your heart begins to beat faster. You think, the market is just shaking. What if I move the stop a little lower? The 4-hour time frame structure has not broken yet. And you move the stop. From minus $50 to minus $80. From minus $80 to minus $120. At this moment, you are no longer trading the system. You are trading hope. Hope is a very dangerous emotion in trading. In real life, hope helps people overcome hardship. Hope helps us try harder. But in trading, hope when you are wrong only prolongs the pain. The hope that price will return to entry so you can exit at break-even is the most sincere desire inside trading psychology. No one wants to lose money. No one wants to see their account in red. Because loss is not just losing money. It is damage to the ego. When you cut a loss, you must admit, I was wrong. And the ego does not like that. So instead of accepting a loss of $50, you choose to wait. Wait for one more candle. Wait for one more United States session. Wait for one more technical bounce. You no longer look at the chart objectively. You look at the chart with the eyes of someone praying. And the market always has a way to make you experience every one of those emotions. The market's method is not to hit you immediately. Its method is time. The market has plenty of time, but we lack patience. When a trade moves against you and does not hit stop loss immediately, but moves sideways for many days, that is the real torture. At first, you still have hope. If it just breaks this level, it will reverse. If volume comes in, it will bounce. On the first day, you still have belief. On the second day, you start to feel irritated. On the third day, you check your phone constantly. On the fifth day, you cannot sleep. A portfolio that stays underwater long enough and moves sideways for a long period will slowly erode your psychology. Not with a strong punch, but with friction. That is when frustration begins to overpower hope. You no longer hope for profit. You only hope to escape. You begin to think, if it just comes back to minus $30, I will exit. If it just gets near entry, I will exit. I do not even need profit anymore. Your psychology shifts from greed to perfectionism to desperation. When frustration lasts long enough, fear appears. Fear of losing more. Fear of account collapse. Fear that others will know you were wrong. Fear of yourself. And the ironic thing is, many traders cut the loss exactly at the point where they cannot endure it anymore. not when the system is wrong, but when the psychology breaks. Do you notice this? Price often reverses right after you cut the loss in despair, because you did not cut according to the system. You cut according to emotion. To do this, the market always has an extremely powerful tool: time. If price drops sharply from the beginning, you hit stop loss and it is done. You lose $50. End of story. But if it drops a little, then moves sideways, then pulls back, then drops again, it traps you inside emotion. That is the psychological trap of holding a losing trade. Holding a losing trade does not only damage the account, it exhausts your nervous system. You begin to get irritated with people around you. You lose focus when doing other work. You check charts unconsciously. One trade losing $100, but it occupies 90% of your thoughts. That is no longer trading. That is obsession. And if you do not recognize this cycle, hope, waiting, justification, frustration, fear, despair, you will continue repeating it again and again. Trading does not destroy you with one big shock. It destroys you with many small losing trades that you hold until you lose confidence in yourself. The important question is not, how can I never be wrong? The important question is, when you are wrong, how do you respond? A mature trader does not hope the market will return. They accept being wrong quickly. They cut losses small. They protect their psychology. Because they understand this, money can be earned again. But a shattered psychology is very hard to rebuild. If you have ever held a losing trade until you lost sleep, if you have ever prayed in front of the screen, if you have ever said just this one time, then this video is not here to judge you. It is here to help you see yourself more clearly. Holding a losing trade is not a technical problem. It is an ego problem. It is the inability to accept being wrong. It is choosing to protect your ego instead of protecting your account. And when you understand that, you begin to change. Hope. That is the starting point of every losing trade you hold. When the trade is only slightly negative, you are still very calm. You tell yourself, the market always pulls back. It cannot go in one direction forever. I just need patience. At this stage, you still feel in control. You still believe you are right. This is the most dangerous state, because it looks reasonable. Hope does not come from stupidity. It comes from partial knowledge. You know about market structure. You know about liquidity sweeps. You know about fake breakouts. And you begin to use that knowledge to defend a wrong decision. Like a lawyer defending a defendant, you search for every reason to prove your trade still has a chance. While the truth is very simple, the market is moving against you. Imagine you buy gold at 5,350. Your planned stop loss is 5,340. Risk $100. Price drops to 5,345. You start thinking the level 5,343 is support. The daily time frame is still in an uptrend. It might just be a shakeout. Price touches 5,341. Your heart begins beating faster. At this moment, you have two choices. 1. Accept losing $100. 2. Move the stop to 5,335. You choose the second option, because hope tells you, just a little more, then it will come back. Hope makes you forget a fundamental principle. When you move the stop, you are changing the system in the middle of the battle, and every time you change it, you are no longer a disciplined trader. You become someone praying. After hope comes the stage of justification. Justification is when you start telling a story that sounds logical, but is created to reduce pain. The market maker is sweeping liquidity. Big players want to take retail stops. News coming soon will reverse the market. You even open more indicators. Search for more confirmation signals. Watch more live streams to hear someone say what you want to hear. You are no longer searching for truth. You are searching for comfort. Justification makes you feel like you still control the situation, but in reality, your account is slowly eroding. Then comes the paralysis stage. This is when price no longer drops strongly. It moves sideways. Minus $150, then minus $140, then minus $160. Not crashing, not strongly bouncing, just floating. Time spent in this negative zone is what truly destroys you. You start feeling tired, no energy to analyze, No desire to look at charts. You just leave the trade there, like a messy room that you do not have the energy to clean. Paralysis is dangerous because you stop making decisions. You let the market decide for you. When frustration overwhelms hope, fear appears. You start calculating. What if it drops another $50? What if my account drops 30%? Should I deposit more money to save it? This is when many people make the biggest mistake, averaging down. They think, the lower price goes, the cheaper it is. If I buy more here, a small bounce will bring break even. But they forget one thing. If the first trade was wrong, increasing size only makes the mistake bigger. Holding a losing trade is not just keeping a negative position. It is escalation of commitment. You invested money. You invested time. You invested emotion. And you do not want all of that to become meaningless, so you keep holding. And finally comes the stage of despair. This is when you stop analyzing. You just want to exit, no matter how big the loss is. You just want the feeling to end. And you press close. After closing the trade, two things can happen. 1. Price keeps moving against your original direction. You breathe in relief. 2. Price reverses strongly. You freeze. The most painful feeling in trading is not losing money. It is losing money and then watching the market move in the direction you predicted after you exit. But if you look deeper, the problem is not the reversal. The problem is that you did not follow the plan from the beginning. If you had cut the loss correctly at minus $100 as planned, you would never experience the emotional chain from hope to despair. You would lose a small amount of money. But keep your clarity. When you hold a losing trade, you are paying with mental energy. And mental energy is the most important capital. A trader who stays mentally clear can earn money again. A trader who is exhausted will continue making mistakes. Remember this, the market has infinite opportunities, but your nervous system is not infinite. The market always has time, but you do not. Time is the tool the market uses to test you, not through violent volatility, but through prolonged waiting. When you learn to cut losses quickly, you do not just protect money, you protect your calmness. And calmness is the real edge in trading. Now, we go even deeper. This is no longer a technical story, no longer about candle patterns. It is about your brain. Why is cutting a loss so difficult? Why does losing $100 hurt so much more than the joy of making $100? The answer lies in the way the brain evolved. Human beings were not born to trade. Your brain is programmed for survival. In the wild environment long ago, loss meant danger. Losing food meant starvation. Losing shelter meant danger. Losing status in the tribe meant being cast out. So the brain prioritizes avoiding loss more than seeking gain. This phenomenon is called loss aversion. It is the tendency to fear loss more strongly than the desire for profit. In trading, when your trade is down $100, your brain does not see it as a number. It sees it as a threat. Your body begins to react. Your heart beats faster. Your muscles tighten. You feel anxious. Your nervous system activates the fight or flight state. But the problem is, you cannot run away from the screen, so you choose the third option, hope. Hope is a mechanism that reduces psychological pain. It helps you delay admitting you were wrong. It helps you preserve the image of yourself that says, I am still fine. I am not wrong yet. But every minute you keep a wrong trade open, your brain must maintain that state of tension. And prolonged tension reduces your ability to make decisions. That is why the deeper the trade goes into loss, the worse your decisions become. Look at a real example. An account of $2,000. Planned risk. 2% equals $40. But you do not cut the loss. Minus $40. You think, it is not a big deal yet. Minus $80. You begin to feel irritated. Minus $150. You feel out of control. Minus $300. You panic. At this point, you are no longer a trader. You are a person reacting for survival. You may do one of three things. 1. Average down. 2. Pray. 3. Close the trade in panic. All three are not rational actions. Why does this repeat again and again? Because your brain remembers strong emotions. If one time you hold a losing trade and price reverses to save you, your brain will learn the wrong lesson. Holding losses can work. And next time, you will hold even harder. This is the dangerous loop. One lucky escape can destroy years of discipline. The market does not need to make you lose immediately. It only needs to occasionally reward bad behavior. That is enough. Now, look at it from another angle. Why do professional traders cut losses quickly? Not because they enjoy losing money, but because they understand one very clear thing. Each trade is only a probability. If your win rate is 60% with a risk-reward ratio of 1-to-1, that means out of 10 trades, you may lose 4 trades. If you cannot accept those 4 losing trades, you do not deserve the 6 winning trades. But beginners are different. They are not afraid of a short winning streak. They are afraid of a losing streak. And when the first trade loses, they look for a way to avoid that feeling, by holding the loss. The cold truth is this: cutting losses does not make you poor. Holding losses makes you poor. Small losses keep the account alive. Big held losses kill the account. But even deeper than that, holding losses is not only a money problem, it is an ego problem. When you enter a trade, you are not only placing money into the market, you are placing belief into it. You are placing honor into it. You are placing your ego into it. So, when the trade is wrong, it feels like you are being denied. Your brain does not like being wrong. It likes being right. So you try to keep the trade open to prove that you are right. But the market does not care whether you are right or wrong. It only moves according to the flow of money. When you understand this, you will realize trading is not a battle against the market. It is a battle against instinct. A mature trader does not try to win every trade. They try to lose correctly. Lose small, lose fast, lose under control, because they understand that big wins can only exist when losses are managed. Now, let me ask you a question. If on each trade you only lose 1% and you accept that as a business expense, do you still need hope? Hope only appears when you do not accept loss. When you accept that, any trade can be wrong. Your psychology changes. You no longer pray. You simply observe. And when you observe long enough, you will realize something very deep. The market does not hurt you. Your resistance to reality is what hurts you. Now, we come to the most important part. Not recognizing emotion anymore. Not analyzing the brain anymore. But this: how do you escape the loop of holding losses in a practical way? Because understanding alone is not enough. You may understand very clearly that hope is dangerous. You may understand very clearly what loss aversion is. But when the trade is negative, your body still trembles. Your hand still hesitates. Your heart still beats faster. So, what should you do? The first solution is not in technique. It is in position size. Most traders hold losses not because they lack knowledge, but because they are trading with a size too large for their nervous system. You may say that you can handle a risk of 5%, but your body cannot. Try a simple test. If a trade is down 1% and you are still calm and sleep well, but at minus 5%, you begin checking your phone constantly. At minus 10%, you cannot focus on work. That means your psychological tolerance is not at 5%. It may only be at 1 to 2%. So the first solution is this: reduce your size to the level where hitting stop loss does not hurt you. If losing $20 still leaves you calm, but losing $200 makes you panic, then do not trade $200. Many people say, if I trade too small, how long will it take to make money? That is the wrong question. The right question is, how much should I trade so I do not destroy my system? Because when you preserve the system, profit will accumulate by itself. When you destroy the system, profit will never be sustainable. The second solution: stop loss must be placed before entering the trade and must not be touched afterward. It sounds basic, but in reality 90% of traders still move their stop. Why? Because they place stop loss at a technical level, but not at a psychological level. A technical stop is where structure breaks. A psychological stop is where you are truly willing to lose the money. If the structure requires a stop of $100, but you are only willing to lose $50, then either reduce your size or do not take the trade. Never enter a trade when deep inside you have not truly accepted the money you may lose. Before pressing buy or sell, ask yourself, if in 5 minutes I lose this amount of money, will I be okay? If the answer is no, do not enter. The third solution: practice cutting losses like a ritual. Do not see cutting losses as failure. See it as paying office rent. A business has to pay rent, pay staff, pay marketing. A trader is the same. Cutting losses is an operating cost. Try doing this. In your next 20 trades, your goal is not to make money. Your goal is this: cut losses exactly as planned. You will notice something interesting. When you are no longer obsessed with having to win, you will trade more lightly. The fourth solution: separate yourself from each individual trade. Do not think, this trade must be right. Think instead, out of 100 trades, this is only one data point. When you look long-term, one losing trade is no longer so important. The problem with people who hold losses is that they pour all of their emotion into one single trade. They forget that trading is a game of long-term probability. If you have a system with a win rate of 55% and a risk-reward ratio of 1 to 2, then across 100 trades, you may still have a losing streak of 5 or 6 trades in a row. If you cannot endure 5 losing trades in a row, you cannot play this game. The fifth solution: design non-negotiable rules. For example, never move the stop farther away. Never average down without a prior plan. If you break discipline 2 times in a week, stop trading for 3 days. Discipline does not come from inspiration. It comes from structure. And finally, the most important thing you need to understand is this: the discomfort of cutting a loss only lasts a few minutes. The exhaustion of holding a loss can last many days. Do you want short pain or long pain? A mature trader does not try to avoid pain. They choose the small pain to avoid the big pain. Hope is not a strategy. Acceptance is the strategy. When you truly accept that, I can be wrong, and that is normal, you will no longer need to pray. You will no longer let the market lead you through hope, waiting justification, despair. You will enter with calmness, exit with calmness, because you understand something very deep. Trading is not about trying to be right. It is about managing yourself when you are wrong. Now, we move to the deepest layer: not technique, not stop loss, not win rate, but this: your nervous system. Because in the end, trading is not a game of charts. It is a game of your inner state. You can have a good system. You can understand probability. You can know that you must cut losses. But if your nervous system is weak, everything collapses when pressure appears. What does a weak nervous system look like? When a long red candle appears, your heart suddenly beats faster. When a trade is down 3%, you cannot take your eyes off the screen. When you lose 2 trades in a row, you begin to doubt the entire system. That is not an intelligence problem. It is a pressure tolerance problem. Where are professional traders different? Not that they do not feel fear, they simply do not allow fear to control their actions. Their nervous system has been trained to tolerate uncertainty. So, how do you build a trader's nervous system? The first principle: become familiar with small losses. Just like going to the gym. You do not walk into the gym and lift 100 kilograms on the first day. You start with 20 kilograms. Muscles need time to adapt. Your nervous system is the same. If you have never been comfortable cutting a loss of 1%, but you trade 5% risk per trade, you are forcing your nervous system into a panic zone. Try this experiment. For 1 month, trade with extremely small risk. The goal is not profit. The goal is this: cut losses without emotional reaction. You will notice something strange. When the amount of money is small enough, cutting a loss becomes very easy. No pain, no hope, no praying. This proves a simple truth. The problem is not the market. The problem is the size of risk you are carrying. The second principle: separate yourself from the outcome. You are not that trade. One losing trade says nothing about your value as a person. It does not say you are stupid or talented. It is only one result inside a probability sequence. But the ego always wants to merge identity with outcome. A losing trade means I am wrong. If I am wrong, then I am incompetent. That is why holding losses becomes a battle of pride. You do not want to lose money, but deeper than that, you do not want to lose your self-image. When you understand this, you can start practicing a simple technique. After every losing trade, write this sentence: this is only one data sample. Do not analyze yourself. Just record it. The third principle: Reduce decision frequency. The more you stare at charts, the more emotions are triggered. A small candle on a 5-minute chart may mean nothing on a 1-hour chart. But if you watch too closely, your brain will overreact. Traders with weak nervous systems often trade very small time frames because they want control, but the more they try to control, the more they get pulled into chaos. Try moving to a larger time frame, fewer signals, less noise, less stimulation. Your nervous system needs calmness to become stronger. The fourth principle: accept uncertainty as a natural part of trading. You cannot know for certain whether this trade will win or lose. If you are still searching for certainty, you will always hold losing trades. Because when price moves against you, you think, this cannot be wrong. But the truth is simple. Every trade can be wrong. When you accept that from the beginning, your emotions will not explode when it happens. The fifth principle: train the reflex of cutting losses. Do not wait for large trades to practice discipline. Practice on small trades first. Treat pressing close when stop loss is hit like flipping a light switch. No thinking, no internal debate. Discipline does not come from motivation. It comes from repetition. Cut losses correctly 50 times, and your brain will begin to see it as normal. And one day when a trade hits stop loss, you will simply say, okay. Next, no pain, no struggle. That is when you reach another level. Mature trading is not when you win big. It is when you lose and your psychology remains intact. When you are no longer afraid of small losses, you will never fall into great despair. And when you no longer need hope, the market will never again lead you through that painful cycle. Hope, justification, paralysis, fear, despair. You will stop it at the very first step. Acceptance. Now, we talk about the final difference. The difference between a person who survives 10 years in the market and someone who is worn down after 2 years. It is not complex strategy. It is not a secret indicator. It is not because they read more books. It lies in a quality very few people notice: calmness in the face of small losses. Traders who survive long-term understand one cold truth. The market does not reward the smartest person. It rewards the person who does not destroy themselves. New traders usually have 2 characteristics. They want to be right, and they want speed. They want to prove that they are talented. They want to see their account grow quickly. They want a breakthrough, and that desire makes them unable to tolerate small losses. They treat each trade as a chance to prove themselves. So, when a trade is wrong, they do not cut it. They hold it. Because cutting the loss means admitting, I was not right. Long surviving traders are different. They do not need to be right on every trade. They only need to be right in the overall result. They do not trade to prove anything. They trade to manage risk. Imagine 2 traders. Trader A, win rate 70%. But when losing, they hold losses until minus 10%. Trader B, win rate 45%. But they always cut losses at 1% according to plan. After 100 trades, who still has money? Trader A will have beautiful winning streaks, but just one large held loss can erase all those profits. Trader B may lose more trades, but their account never collapses. Trading is a game of survival, not a game of moments. The survivor understands this. If the account survives, opportunities remain. If the account dies, the game ends. So they protect their account as if protecting their life. The paradox is this: when you are no longer afraid of small losses, you become more dangerous in the market, because you are no longer led by hope and no longer dragged by despair. You simply follow the process. Traders who get worn down repeat the same cycle. Trade well for a while, become overconfident, increase position, size, hold losses, lose most of the profit, start again. They do not die immediately. They bleed slowly. The real difference is not knowledge. It is the ability to maintain a stable state when facing uncertainty. Long-surviving traders do not become overly excited when they win. They do not collapse when they lose. They understand that extreme emotions are the enemy of sustainability. And most importantly, they never allow a single trade to define who they are. When a trade loses, they do not say, I am stupid. They say, probability. When a trade wins, they do not say, I am brilliant. They say, probability. That calmness is built from hundreds of correct stop losses, not from hundreds of lucky holds. If you truly want to reach that level, start with one very small change. Love cutting losses more than holding profits. It sounds strange, but when you learn to protect the downside, the upside takes care of itself. The market does not require you to be right often. It only requires that you are not wrong too big. Hope is instinct. Acceptance is skill. Holding losses is a natural reflex. Cutting losses is a trained reflex. And between those two reflexes lies the border between the trader who is worn down by the market and the trader who becomes mature. Finally, remember one simple thing. You cannot control the market, but you can control the size of your mistakes. And when your mistakes are always small, no despair will ever become big enough to destroy you. From hope to despair, there is only one decision in between. Do you dare to accept being wrong while the mistake is still small, or not? Trading is not a journey to find the perfect trade. It is a journey to train yourself to become strong enough not to destroy yourself.